Well, hello and welcome to this Moneycontrol live stream. It's a Thursday morning and you're watching Morning Trade with me, Nandita Khemka. Well, lots of cues to digest this morning given the kind of blowout GDP figures that came out last night. The US House, in fact, has also, voted in favor of the debt ceiling deal. And of course, the SGX Nifty is hinting at a muted start, but looks like we are going to hover around that 18,600 mark in today's session. And of course, we'll also be getting all your stock-related queries answered by our technical expert on the show. So if you have any queries, send them in to us on our YouTube feed and we'll have them addressed during the show. But before we do all that, let's take a quick look at the headlines at this hour. US House passes a bill to raise the debt ceiling days before the government was expected to run out of money to pay its bills. Wall Street skids overnight as job openings rise in May, giving way to fears that the Fed may raise rates again in the face of consistently strong labor data. Asian markets trade largely lower even as the US House passes the debt ceiling bill. The SGX Nifty is signaling a subdued start for the Indian market. Oil prices dip on a larger than expected build-up in US stockpiles and fears of weak Chinese demand. In fact, Brent falls to $72 a barrel and a stronger dollar also weighs in on prices. India's GDP growth in FY23 comes in at 7.2%. That's above estimates. In fact, a faster than expected 6.1% growth in Q4 takes the full year GDP growth above the government's advance estimate of 7%. TCS veteran and former head of the BFSI vertical K. Krithivasan takes over as the TCS CEO as Rajesh Gopinathan steps down. While no strategy changes are expected, the key ask from the new CEO will be to outperform its rival Infosys on the growth front. Well, without any delay, let's bring on board then Nilesh Shah, MD and CEO of Envision Capital, joining in this morning to talk about the market setup and, of course, the kind of data that came out last evening. Good morning, Nilesh. Good to have you on the show. I want to ask you, the kind of GDP data that has come in and the fact that inflation is below that 5% mark. Even on the market front, we are up 10% from March lows and the Nifty is just about 2% shy of record levels. So, everything is going in favor of India at a time when global or advanced economies are looking at a slowdown. So, what is your sense? Where are we headed from here?
Good morning, Nandita. Pleasure to be on this show. And yes, this has been terrific set of data which has got released last evening. This is precisely the kind of data that we all were looking forward to, because numbers of growth of 6.1% for the fourth quarter and 7.2% for the full year, and inflation trending lower. Pretty much, I would call this a Goldilocks situation for India, where you have solid sustained growth and an inflation which is moderating. So these are essentially great macroeconomic data points, at least in the backdrop where we have so many of headwinds coming in from the global arena. So in this context, it's great. I think we've just completed an earnings season. The earnings season has been above expectations. Corporate India seems to be on a roll. And I think this should continue going forward. And the big trigger to really watch out for is what RBI does in terms of its rate stance. I think if we begin to see rates peaking or maybe even kind of now gliding down, that would be a big booster. So I think on the whole, solid news for the markets, great tailwinds. We will have to contend with the global macros, but I think India should be able to take all of that in its stride and move forward, and I expect the markets to continue to be strong.
Right. Nilesh, since you spoke about what the RBI is expected to do in the coming policy, well, a pause is more or less factored in. But given the fact that, data is supportive on the growth front as well as inflation front, would you expect a rate cut to come by sometime in October, or, would it be later than that?
Yeah, I would believe so, that, October would be a good time to kind of start the cut in rates. And that's purely because we will have our local inflation data to support that. We would be done with the monsoon, which hopefully should not be a challenge. And by then we would know what the US Fed is doing in terms of its own interest rate. So I think these are the three factors which we would be done with over the course of next few months. So I think, yes, October should be a great time to kind of expect the RBI to start cutting rates. But we will have to closely watch the situation, especially in terms of what the US Fed does with its own interest rates.
Right, speaking about the markets now, we are just about, at the 18,600, 500 level. Not to sound very pessimistic, but do you think that we can expect a big correction to come in before we make our way towards that 20,000 mark?
I don't think so, Nandita. It's hard to, of course, really be able to forecast short-term moves in the market. But I don't think so, especially with the kind of both macroeconomic data that is coming out, as well as in context of the earnings season. I think in that context, I wouldn't expect any kind of a meaningful correction. The only joker in the pack is what the US Fed does, because we are currently in a risk-on mode. And we just want to kind of see what the US Fed does in terms of its own stance. And I think if the stance continues to be one of not accelerated hikes or anything like that, I think we should be fine. So I think both the US Fed interest rates plus our own monsoon are the only two variables that we need to watch out for over the course of next few weeks. But otherwise, there are solid tailwinds to support the market up move. In addition to that, we're seeing FPIs who've turned net buyers. That I think again is a big overhang, which is kind of out of the way, at least for now. So on the whole, strong earnings, strong macroeconomic data, and strong liquidity, all three things growing in favor of the markets.
Right, things going in favor of the market. So which theme should one look at to ride this, up move? Would you say rate sensitives look good now, given the fact that, we can expect the rates, interest rates to, have been peaking and, of course, a rate cut to come by sometime this year? Or would you look at some of the other sectors right now? Which one would you advise investors to look at?
No, I think two pockets which look very, very strong and robust. I think rate sensitives clearly. So rate sensitives like property, real estate, automobiles, these are the kind of areas which I think should benefit. They again have had challenges in the last few quarters as interest rates kept moving up. But if interest rates pause and they start to decline, clearly real estate players, automobile companies should do well. And on the back of that, even auto component companies, which are also a flavor of manufacturing. These are the kind of sectors which should do well. The second is discretionary spending should continue to do well. I think sectors like travel, tourism, hotels, hospitality, these are some of the pockets which again should continue to benefit as consumers gravitate towards more discretionary spend. And the third area is the capex or the cap goods companies. There, of course, post the recent up moves, the valuations have become a tad higher, but I still think that there's solid growth momentum out there. We've again seen in Q4 that what really lifted the GDP data was investments and the capex space, and I continue to believe that trend will sustain for a few more quarters. So I think it's a combination of rate sensitives, discretionary spending, and the capex and investment-related sectors, which I think should continue to be the favorites.
Right, those are the sectors to watch out for. Lastly, Nilesh, what would your call on IT be? A lot of, analysts are taking a contrarian view on IT, saying that valuations have become very attractive and, post a couple of quarters, things may stabilize for this pocket. What are your own thoughts?
IT continues to be a very interesting space, just that the big boys or the large caps, I think probably still there's some way to go before they trend lower. And they become really attractive buys. So I would still think that the large cap IT probably still has some downside, as the guidance still talks about, low single digits or mid single digit kind of growth, which is not the kind of growth investors will really kind of cheer about, especially if you're investing in growth oriented sectors. But mid cap IT, small cap IT looks very, very interesting. I think there are some very select companies which are poised to grow in double digits, and where valuations still are reasonable. So I would tend to think that on the whole, IT looks interesting, but go for mid-caps, selectively go for mid-caps and small caps versus the large caps.
Right, Nilesh. With that, appreciate taking out time and joining in this morning. It was a pleasure speaking to you this morning.
Thank you. Thank you as well, Nandita.
Thank you. Well, with that, let's shift focus to technicals then. Gaurav Bissa of InCred Equities is joining in this morning. Good morning, Gaurav. A lot of volatility, in fact, a lot of action coming in to play in the last hour of trade yesterday. We saw the Nifty, even though ending with cuts of triple digits or thereabouts, but there was a lot of action happening. A lot of stocks, edged towards the day's highs like Kotak Bank, Bharti Airtel, of course, in the wake of the MSCI changes that kicked in. So what is your sense this morning? SGX Nifty is hinting at a start at around that 18,600 mark. Would you expect a subdued open this morning?
Good morning. See, if you look at how the US markets were placed or how the Asian markets are trading at this point in time, there is a possibility that we may start with some amount of negativity. I'm not going to say a big gap down opening, so to speak of. But yes, we can have a subdued or a muted opening at the beginning of the trade. What is interesting is if you look at the option data of the current series, weekly series, then 18,500 put commands a very good concentration. We did not see too much of panic coming in option writers. So if we are sustaining above 18,500, then I think we can see a very strong pullback towards second half of trading session. But if Nifty continues to trade below 18,500, then the 18,500 put writers will be forced to cover their positions, and probably we can see some more pressure building up. There are two interesting things apart from the OI data that we mentioned on the option front. If you look at the previous swing high breakout level was 18,450, 460. Yesterday we reversed from around those levels only. So we have already seen a breakout retest. There's already been gap filling that has happened over there. So things are looking good. Probably 18,460, 470, and from there on we can see a nice up move towards 18,700. Not today, but probably in a couple of trading sessions we can head towards 18,700 for Nifty. For Bank Nifty, 44,000 is the key support area to watch out for. If that is sustained, probably 45,000 is on the cards.
Right, those are the levels to watch out for on the Nifty and Bank Nifty. Let's talk about the stock of the day, Coal India. In fact, the government will be looking to sell somewhere around 3% stake in the counter. 1.5% stake sale is what the government is looking to offload. But there's a green shoe option of another 1.5% stake sale. So, at a floor price of 225 or thereabouts, it will be at a discount of the floor price is basically at a discount of somewhere around 7% or thereabouts to yesterday's close price. Now, if you look at the stock, it is very close to the 52-week high of 263 rupees or thereabouts. In the last 1 year, the stock has given returns to the tune of 24% or thereabouts. Should one use dips to buy into this stock now?
Well, I'm not very bullish on metals and mining space for a longer period of time, but probably June we'll see some amount of bounce back coming in this space. Specifically speaking, Coal India, it gave a breakout around 205, 207. It made a retest of the breakout area and went up higher. It's forming higher tops, higher bottom on the weekly chart. That again is a positive sign. So I think if it's coming around 225, probably 220, one can buy, use a stop loss of 205, and probably again it can go towards the level of 245, 250.
Right, that's about Coal India. Let's talk about Torrent Pharma. Now, this stock, I think, rallied somewhere around 6 to 10% in yesterday's session. Numbers were fairly good, and today we have an upgrade coming in from HSBC. HSBC has upgraded the counter to buy from hold, and the target price has been raised to a little over 2,000 rupees a share. Resolution of US FDA issues will be a key catalyst for the stock going forward. That's what HSBC is saying. Stock was up 6% yesterday. On a 5-day basis also, it's up somewhere around 7 to 8% or thereabouts. So it has been in an uptrend of sorts. Is this a time to ride this rally?
One can ride the rally. If somebody has already bought, then I think it makes good case to remain in the name. It's trying to give a good breakout, and if it sustains above levels of 1840, then probably fresh entry can also be made, keeping a stop loss of 790, and you can play for 1950 kind of target. So the structure is good. It's giving a breakout from rising trendline resistance area. Volume participation yesterday was good. If you are seeing follow buying happening, and if you are seeing prices sustaining above 1840 something, then I think we can see second round of upside coming in Torrent Pharma.
Right, some bit of upside is expected on Torrent Pharma. Let's take up some viewer queries then this morning. We have a query coming in from Chandan Gupta on Dixon Tech. Now, there was news flow around this counter yesterday that it is tying up with Xiaomi to make, iPhones in India. What is your sense on this stock now, given the fact that we saw a very healthy up move come in on the stock yesterday? Time to take position in this one?
I would not recommend that. See, it was consolidating for a few weeks, or you can say a couple of months, and then it came out of that lull. We witnessed a good breakout retest at levels of 3,200, and from there on, we have seen move coming towards 3,900. So there has already been a 600, 700 points upside that we have seen in a very short span of time. And from here on, the risk reward will not be favorable. I'm not saying it will stop at the current junction. It may probably go higher, another 5, 10% also. But the point is, where will you keep stop losses? If I keep a stop loss of 3,200, that will be too deep a stop loss. If I keep a very tight stop loss, 35, 50, 3,600, if there's already some amount of profit booking, that can get triggered. So risk reward, I don't think it's in favor of fresh buying. But somebody who has already bought can keep riding the stock. But I would not suggest buying it at this point in time.
Right. Gaurav doesn't suggest buying into Dixon Tech yet. So I hope this answers your query. But let's also talk about auto stocks. Auto sales figures for the month of May will start trickling in today. Expectations are that, passenger vehicle demand will remain subdued and, small car segment, the discounts have risen. So, you may see an uptick in the sales figures for small car segment, where that is concerned. It also believes that MHCV demand has not recovered fully yet. That's the poll that's throwing up. And two-wheeler demand is expected to see a marginal uptick. Now, among the four-wheeler space, what would your take be on Tata Motors? And, from the two-wheeler space, which stock is looking good on the charts right now?
So for Tata Motors, I'm pretty bullish on that. But the thing is, it gave a breakout around levels of 460, 470, and from there on, we have seen the stock rising higher. At this point, I'm not saying it is looking weak, but again, like I said, the stop losses will be deeper at this point in time. On the other hand, if somebody wants to take a risk, then probably if it sustains above levels of 540, one can keep a stop loss of 520 and play for targets of 570, 575. That can be a trade, but it will have some risk because it's coming out of that 2-year consolidation where you have a hurdle at levels of 540 around, and once it sustains those levels, you can see fresh breakout sort of. So that can be a trade, but not at the current juncture. Either you buy on declines or you buy once it confirms a breakout above 540. As far as two-wheelers are concerned, I think Bajaj Auto has already seen a very strong upside. It's not witnessing, I would say, fresh breakout sort of speak of. This one is also not in favor. And beyond that, see, TVS Motor has been one of the strongest names. So that's a good name to add, but on declines, not in the current juncture. That leaves only with Hero Motor. That is trying to give a breakout from falling trendline pattern. That is something that one can buy. I would suggest keeping a stop loss of 26.75, and if breakouts are sustained, one can play for targets of 2,900.
Right, that's the call. Bajaj Auto looking attractive. Let's take up a query on the oil marketing space. Raja Pasala has written in and he wants to know your thoughts on HPCL and whether he should be entering at the current juncture. Now, there is some bit of crude comfort emerging for these oil marketing companies. We've seen a good rally come in stocks of HPCL, BPCL and the likes. So, should one look at HPCL or, it's better to look at something like a BPCL right now?
Sorry for that. See, if you look at OMC space, HPCL is coming out of consolidation. It's yet to see a confirmation of that. But once it sustains above levels of 267, you can see fresh breakouts sort of coming in. The cleanest of the breakouts was seen in IOC, which is generally not in minds of market participants. It's the least interesting name in terms of OMCs. And second, I am not bearish on OMC as such, but they don't have history of sustaining the breakout area. So it always entails a risk where it gives you a disappointment. It's a highly regulated sector as well, so you never know what comes around in the space. Also, it's highly defined and influenced by the global crude prices. So there are multiple factors looking at. So if you look only in isolation, that might not be the right approach. But if I were to answer this question, I think about 267, HPCL is one that should be on the radar.
Right, let's take up the next query. This one is coming in from Tejas Jain on HDFC AMC. Now, these, this stock has rallied somewhere around 12% in the last 5 sessions itself. Would you advise somebody to, book profits in this counter, or, it's time to take positions? And if you are holding this stock, what should you do?
See, if you're holding the stock, then probably one can keep holding it. See, if you look at the weekly charts, it's still forming a series of lower top, lower bottom, which is the characteristic of a downtrend. However, we are seeing some divergences coming in momentum indicators, and there's a bullish MACD crossover, and we have seen a good upside happening after that as well. So one can keep riding it. I would not recommend buying fresh over here because it's already moved up a bit, and if I want to buy here, my stop losses will be around 17.10, 17.15. So that will be more than 10% from the current juncture. So the risk reward would not be that favorable. And I don't want to, I don't believe in chasing the stock prices. It's already moved up very fast. Now, if somebody wants to chase that, that's not the right approach. A small correction in Nifty or in the stocks can trigger your stop losses. And people have habit of not following the stop losses. So on that perspective, I would not advise buying fresh. But if somebody has already bought, I think once it sustains about 2000, we can see some more upside in the stock towards 2120, 2140. One can keep holding it, but do not buy fresh.
Right, do not buy afresh into HDFC AMC. Couple of queries coming in on Suzlon. Debjyoti and Ashish, they want to know your thoughts on this counter. Now, this stock is near 52-week highs, has been winning orders consistently over the last 1 month. It has won 6 orders. Numbers were good, debt has been reduced. Should one look at this one now? Everything seems to be working for this company going forward.
See, to be honest, I do not track stocks which are in single digits, something like Idea, JP Associate, Suzlon, for the very reason that many times they are so volatile, and people tend to buy aggressively because it's just a single digit stock. How much will you lose? All that things come into picture. So I would refrain from giving a view from here. I apologize for that, but this is something which is on my avoid list. So I don't track these names.
Right. I think we just about have time for last query on our show. Krishna has written in, wants to know your thoughts on HDFC Bank. He holds a few at the rate of 1,605 rupees a piece. What should he do?
One can definitely hold on. It's bouncing back from strong support area of 1580, 1585. You can use that as a stop loss. As a disclaimer, we have also advised HDFC Bank by means of a technical report to our clients at InCred Capital. So one can keep holding it. There's a strong hurdle at 1700 to 1725 zone. Once it gives a close above that, you can expect another 10% upside. So in my opinion, risk reward is in favor. Keep holding it. Use stop losses, but I think the structure is very strong.
Right, that's the call on HDFC Bank. I think we've come to the end of this query segment today. But Gaurav, any stock recommendations for viewers this morning?
See, we have recommended Envision Bank to our clients, and it's giving a good breakout coming out of a strong consolidation. It's a positional call, not just a trading call as such. So we have advised a 300-point upside in Envision Bank. One can keep a stop loss of 1185, and one can buy Envision Bank.
Right, InCred Bank is a stock recommendation coming in from Gaurav. With that, Gaurav, thanks a lot for taking out time and joining in this morning. Appreciate having you on the show today. Well, with that, we have come to the end of this edition of Morning Trade. But don't go anywhere because coming up next is Opening Bell. So thanks a lot for watching.